It was a super exciting morning for me. I woke up to reading and looking at 𝗟𝗦𝗧𝗧𝗘𝗥's Twitter, and Joe was in Jackson Hole, Wyoming. The Kansas City Federal Reserve Office holds an annual conference in Jackson Hole, Wyoming every year, and gathers most of the people in the global and U.S. banking industries. Lots of economists, lots of press are there. Fed Chair Jerome Powell was there, and woke up to Joe 𝗟𝗦𝗧𝗘, more or less describing what Jerome Powell was saying about the markets and what's happening in the world. And just literally, as a developer, it's like a fist pump kind of morning. Excited, amped up. And part of the reason is Jerome Powell's indicated to us that he is going to drop rates, which is exciting. It's so great. It's been a brutal journey over the last 4 or 5 years for anybody in the development and acquisition space in commercial real estate. We got hit with COVID in March of 2020. There were moments there in the first few months where some of us, I think, were wondering, is the United States going to exist anymore? Does the world exist anymore? Are we all going to die within a month? It was wild. There was a lot of really terrible things that happened through there. A lot of people were hurt or died during that time period. But it was just wild to try to figure out what the markets were going to look like, what life was going to look like for all of us, just even on a day-to-day basis, let alone in the business world. And as soon as we came out of that, we started hitting these supply chain crises. And there were moments where plywood, sheets of plywood that used to be a couple of dollars a sheet, we started running for $50, $60, $70, $80 a sheet. And then you saw stuff like TPO roofing having, crazy, wild 20 to 50 week lead times. And this is just normal stuff we put on every roof we go everywhere. So we kind of got through that time period. And then we just got hit with what I really describe as the trifecta. And that was the Fed increasing the federal funds rate 500 basis points over a 16-month time period. For anybody who works on a margin, that was brutal, right? I mean, there are dozens and dozens of assets for all kinds of people, various operators, ourselves, our peers, that were instantly in trouble. And not because the assets were in trouble. It's just because by the time we got from the start of the asset life to where the asset was being finished, in our case, where we're building them, by the time we got from the start to finish on these assets, there was just no margin left on the deals. So it has been a rocky, turbulent ride over the last 4 or 5 years. And for me, for one, as I was getting going this morning and thinking about my day and thinking about where life was headed for me over the next 1 year, 1 month, 5 years, 10 years, I was amped up. And I so appreciate my friend Joe, kind of giving us the live updates and what was happening.
I asked Johnny Clawson to join me this morning and weigh in a little bit on this morning's notes that came from Fed Chair Jerome Powell at the Jackson Hole Conference. Johnny, thank you for joining us. Johnny is a commercial mortgage broker, and he's actually a third-gen commercial mortgage broker based here in Utah, and has operated in 37 of the 50 United States and placed loans there. They typically operate with a bigger footprint throughout the mountain and desert states, but definitely have an active, book of business that expands, and they chase their clients nationally. Is there anything else, Johnny, we should tell the world about you other than you're just the best commercial mortgage broker that I work with?
I think that would sum it up.
Perfect. I always describe Johnny as a developer-friendly commercial mortgage broker, and what I mean by that is so often when you're speaking with people on the lending side of the coin, a lot of the time, they don't always understand what it's like to be a developer. And I think one of the things that Johnny does that separates him from a lot of his peers is that he's constantly putting himself into the shoes of what a developer is looking at. And a lot of the time, he can understand what my concerns are before I've actually verbalized them. And so, Johnny, what it feels like to me is after 2 years of pain and suffering, we've made a big shift here, and we've got, this hope on the horizon, right?
Yeah, I would say 100%. Rates are going to come down. 24, 36 months ago, life was easy for everybody, right? Every broker was making money. Interest rates were in the low threes. It was hard not to make a deal work at 3%. Then over the last 12 to 24 months, we experienced rates in the 6, 7%. You had compressed cap rates, so you had a big disconnect between buyers and sellers. We went from an environment where brokers are going out to market and coming back with 100 offers to where interest rates are in the 6, 7%, and they're coming back with very limited offers, and usually offers that don't pencil either from a buyer's perspective or from a seller's perspective. So it's been a tough environment. There's been people that continue to make deals happen. But I think with what you're talking about right now, Chris, is that we're in a moment in time where you could capitalize on investment opportunities because you know that the rates are going to come down in the next 3 to 4 weeks when the Fed meets here in September. You have an opportunity to buy at maybe a distressed cap rate or a softer cap rate, tie that project up and then potentially rate lock at an interest rate that's going to be 25 to 50 basis points lower. I mean, we're expecting the Fed to meet here in September. We're expecting to see at least a 25 basis point cut. It could be as high as 50 basis points as I talk to some of my life companies who have economists internally who are making predictions. And obviously they're just predictions, right? But they're thinking it could be as high as 50 basis points, which would be massive from an investor return on perspective. I think what we'll see probably in the next 2 to 3 weeks is the 10-year Treasury make some adjustments in anticipation of the Fed meeting. So I think you would either see that 10-year Treasury start to fall, and then I think when the announcement's made, depending on how big the cut is, you can see that 10-year Treasury drop. I mean, over the last 12 to 18 months, we've never been in an environment where we've seen big movements in the market, a very volatile market where you're seeing the 10-year Treasury move by 10, 20, sometimes 30, 40 basis points per day. So, I think a lot of people are just trying to find some stability. The 10-year Treasury has continued to decline. It's at 3.8. For the right deal, you can be in the low to mid fives on an interest rate. And when the Fed meets, I mean, depending on what happens, I was talking with one of my life companies yesterday that we could actually start to see rates start with a 4. So if you're going out and locking up deals today, assuming a softer cap rate, knowing that you could potentially rate lock even 50 basis points lower, you just hit a home run.
I'm glad we did this on video so the world can see me smiling as you throw out the 4 handle. Yeah.
But no, I mean, it's one of those windows in time that you will look back, and if you were aggressive today and went and locked up some assets, and then lock those deals potentially in the next 3 to 4 weeks, you could capture a huge margin on that return. I mean, it would be crazy. It's going to be crazy.
I was going to say, it's an interesting moment in the market because if you compare this to like coming out of 08, 09, the sentiment then, or at least what was going on, is the Fed was actually dropping the Fed funds rate, right, to kind of encourage us to come out of the recession, right? And so this one's different where it's like now we're dropping the rate, but we haven't had that big asset drop like we had in 07 and 08, right, and going into 09, right? And so it's quite different, right? So how long does it take for this to, how long does it take for the street to start pricing this stuff in? So let's say we get a 50 bip, correction or a 25 bip drop in September. Is it an immediate? Do you see it right away from the life cos?
So you will see an immediate change. Depending on how fast the Treasury falls, life insurance companies always have floor rates. So they may say, like today, the floor rate might be 6% or 5.75 could be a floor rate today. No lender wants to ride the market down 100 basis points just to see the market rally back 100 basis points. So you're going to see that rate fall. What you will see is that you have a lot of lenders who haven't got allocations out. Lenders have to get dollars out. So a lot of them haven't got dollars out. So a lot of them will look at this as an opportunity to place debt that they needed to get placed. But you're also going to have some insurance companies that are going to come back and say, hey, we're going to set our floor rate at 5.5% or 5.25%. And then we're going to wait and see, does the market stabilize? Does it hold for a week? So you might actually see some lenders exit the market for a week just to see what happens, or they'll just quote deals at their floor rate. But you're going to also see some lenders that are willing to ride that market down because it's also a great opportunity to steal deals that are really nice assets that they're not having to compete with another 100 lenders for. So it'll be really interesting. But to answer your question, Chris, yes, it will be immediate because lenders are quoting a spread off that treasury rate. So whatever that treasury rate is going to be your new rate.
And when you say they have dollars to spend that they haven't invested, so they're behind the curve on the allocation, do most of them work on a calendar year?
Yes.
So
most lenders will get their allocation for the year in December, knowing what they've got to get out that following year. I would tell you that most lenders' allocation for 2024 was much larger than 23. I think the outlook in January of 24 was better. Everybody was expecting 24 to be a fantastic year. It just hasn't quite turned out that way. So you've got lenders who had a lot of dry powder on ready to lend and no deals to lend to because the deals weren't penciling. Because you're trying to pencil a 6.5% interest rate, you can't get the coverages that you need, and so deals just don't happen. But if all of a sudden, rates come down 25, 50 basis points, there's a lot of activity. Just seeing the Treasury drop below 4 over the last 2 to 3 weeks has been massive. Our volume is up. The number of calls and deals that we're looking at is probably up 25 to 30%. So it's been amazing just because that drop is just enough to move the needle. So all of a sudden, if we're going to see another cut and the Treasury falls another 25 to 50 basis points, it's going to be a feeding frenzy. I had a call to client. They're apartment buyers, and they are in the process, and their goal is to get 3 apartments locked up this week. And they feel like if they can lock up those 3 apartment deals this week and then rate lock after the Fed meeting, they feel like they may have just picked up an extra 10 to 15% just by locking up something today. Because their feeling is if they wait and can't get it locked up here in the next week to 2 weeks, that price goes up. Just because the interest rates are going to come down, all of a sudden, you got more buyers looking at it, and the price of that deal goes up. So there is huge opportunities this week.
Yeah, just as one last parting thing, maybe for some humor for us. Remember when all these banks had rate floors? Because the interest rates were so low that they wouldn't go below a certain number. Oh, those were good times. Yeah. If you are in market for debt, if you are a syndicator, if you are a developer, if you are a family office, give him a call. Good grief, if you sell apartments and you don't call him within 10 seconds of listening to this to figure out what you can put in front of his client that is an active buyer of apartments right now today, I think you're nuts. So anyways, hit up Johnny. He's great. He's an excellent resource. Thanks, Johnny.
So as part of this, I have asked a couple of really key investment brokers that help us do lots of retail investment sales across the country. I pinged them this morning and said, why don't you just share with me the number one best thing that you have right now that you're selling? And what I want to do is walk through the highlights of what today means in terms of those assets. So the site is located adjacent to an Aldi. It's located across the street from a Trader Joe's. Killer suburb here, great little retail pocket here in the northeast part of Indianapolis. So it's a new 12-year lease. The tenant just recently put a brand new roof on, and it's a 7 cap. And so we got to look at that PetSmart credit. We got to look at a PetSmart, how it's doing. Obviously, PetSmart's got some of the best pet analytics in the business. It's really a pet data company that's selling pet supplies on the side is how I would describe PetSmart, and it's obviously top of class from a tenant standpoint. Here you got brand new 12-year lease. You got a 7 cap. You are more than likely going to be able to get positive leverage almost out of the gate on this. I'm guessing you're going to have some life co's chasing this, and we're going to probably be pretty juicy debt in the low 5s. And if we get a few rate cuts, who knows? If that drops into the 4, you're easily going to slip into positive leverage territory plus. And so you could have a good refi opportunity in, say, 6 to 12 months if rates continue to trend downwards. Next up is one of my favorite tenants to talk about. If anybody follows me for more than 5 minutes, I love Dutch Bros. And so it only seemed fitting to present a Dutch Bros today. I'm grateful that Daniel Harold and Matt Spangberg with Northmark sent me over one of their Dutch Bros listings. This one's a ground lease in Montrose, Colorado. A couple of really awesome facts about this. It's a ground lease. It's a 5.25 cap rate, and the rent is just dirt cheap at $118. If you look at the Dutch Bros comp set, the average rent that's in place is somewhere in the 140s to 150s. Now, you do have a lot of build-to-suits in there, so we're starting to see less and less of these ground lease properties available with Dutch, so they're fewer and farther between. But I like that this is a brand new ground lease, just commenced rent. It's commencing rent in next month in September. And one of the side extra bonuses about this deal is if you get to Montrose, you got a great skiing all over the place within, a short distance or a little bit longer distance, but lots of different ski options. So if that's your thing, is you're looking for somewhere to ride off your ski vacations, this could be a fun one. Nothing wrong with the ground lease. Once you're over 5, really once you're out of the 4 cap territory and you're on a ground lease, I think you're always sitting pretty generally. So it's an attractive looking deal. Snyder and Carlton sent over so many options, so we have to circle back to this team. They didn't just send over Cabela's for us to look at, and I'm a little bit of a redneck here for sure, and so I can appreciate this stat more than any. They sent me a Cabela's to look at that was the #1 store for ammunition sales in the entire chain. So I just conceptualize that for a minute. They're selling more ammo out of this location than any other Cabela's, which is really wild. Going to Cabela's is like going to an amusement park for rednecks. And so that's pretty amazing, and it's a pretty wild statistic. So this Cabela's is located in Mitchell, South Dakota, and it definitely wins an award for the most creative site plan. I have no clue how this came to be. Very odd, kind of entertaining. Kind of fun deal, though. You got $1.5 million, just under $1.5 million on the NOI. It has assumable debt at 4.25 up till 2029. So if you can figure out a way to capitalize that, and then you're looking at interest rates in comparison to today and saying, what are they going to be in 2029? At, below, higher, and you can kind of come up with your summary of how you'd want to try and buy this. I love the 2.75% annual increases. So CPI or 2.75, whichever is higher. I love that. And I love the tenant. Again, I'm a redneck at heart. You're selling more ammo than any other store in the chain. Highly unlikely this thing's ever closing. John Andrini is one of the partners at CP Partners out of San Francisco, and he shot over to us a multi-tenant strip mall to look at with Starbucks as the mini anchor here. This one's located in Quincy, Illinois, on the far west side of Illinois. And here you've got a 6.85 cap rate Starbucks plus 3 tenant building at $4.4 million. Interesting thing about this is all 3 of the tenants outside of Starbucks all have renewed their lease. So that really indicates strong sales performance. Units are going well. A tenant's not going to renew if things aren't going well. They've all renewed the lease. And you can see that when you look at this rent roll. Comparing this to new construction, here you're sitting here looking at rents on those other 3 tenants, $31, $28.87, and $28 a foot. You can't reproduce that. If you go look at building retail shell almost anywhere in America right now, your rents are going to point you into the $38 to $45 a foot range on your non-drive-through space. Otherwise, you can't make the money. So anytime you see these rents at those lower amounts, it just means simply that this building was constructed back in 08, 07, right when this thing was put together, and they've just have ratcheted those rents up through the escalation process. Here, there's an extra weird thing where Starbucks has actually renewed the lease for 15 years and just did that recently. And so odd that you, number one, have a Starbucks term that's 15 years, and number two, this is on a renewal. So clearly that indicates some great performance out of Starbucks. It's got to be a great store for them. There's no reason they wouldn't. I also love the rent at $105,000, and you got an average unit volume in the Starbucks chain in low 2 millions. Your occupancy cost here is likely tremendous. And so we're going to pull some placer data on this one, but my guess is this is going to point to the Starbucks being in the top 25% in the state of Illinois, and it likely, as all indications, looks like it's a very healthy rent to sales occupancy ratio. Well, I hope you enjoyed my thoughts on the takeaway from the Fed conference that happened in Jackson Hole, Wyoming this week, and what Jerome Powell's thoughts were this morning on Friday morning. Here at our office, we have a development company, Forza Development. We have a property management company, Forza Commercial, and we have a brokerage, Legend Partners. So no matter what you're in the market for in commercial real estate, we can help you here. If you're looking for that next purchase and you're a family office, please reach out. We'd be happy to get you dialed in and something that works appropriately for your portfolio. If you're a syndicator or developer, the same goes there. And if you're just interested in investing in commercial real estate and you're not an active investor, you're not somebody who's looking to put the deal together yourself, but you'd like to play a passive role, please reach out to our folks and let's determine if we're a good fit for each other for you to look at being a limited partner in one of our opportunities that's available.